Hi, this is Uncle Kevin. Today we're going to talk about mortgage bond or home loan. Yesterday I had a personal financial planning session with a client of mine, Yen in Pretoria, and he and his wife is planning to buy a house, and he was looking for he wanted to find out more about a home loan and how to deal with a home loan. So that actually prompted me to do this video because there are quite a lot of people at various stages of their life. Maybe they haven't got their first house. Maybe they haven't had experience of dealing with banks in getting a home loan. And so what kind of questions do you need to ask, and how much can you afford, etc. These are all questions that a person who wants to get a home loan will be interested to find out. So I think this video will help you to make the right decisions, ask the right questions, and make sure that you are taking advantage of the best deal out there to further your financial position. And the first thing you need to ask is that how much do you need to get a loan for? So for example, maybe let's say you're buying a house, let's say for 2.5 million rand. And in addition to that, there will be additional cost. When you buy a house, property, there are additional costs in terms of conveyancing fees, in terms of bond registration fees, in terms of transfer duty, property transfer duty, etc. And maybe you would like to spend money to renovate the house. You want to make some changes to the house. It's not exactly the way you want, and you maybe want to add extension, or maybe adding a studio for home office, etc. There's additional cost. And so you need to all plan and take that into account. And that could be part of the amount you want to apply for in a home loan. And maybe the renovation or any addition that you're going to, and the moving of the house, if the bank allows you to take all that into account and to apply for such a higher amount compared to your purchase price, that's something you do need to think about. So in terms of the amount of home loan you are going to apply. Then the second issue is that you need to think about is that the interest rate. And you do need to, when you apply for home loan, and certainly you should look at comparing, say, 2 or 3 different banks, what kind of interest rate they're willing to offer you. And here, the service of a home loan originator can be quite valuable, where they go around and on your behalf, they go to various financial institutions, 3, 4 banks, and try to get the best deal for you in terms of interest rates. Here, it's important to compare the interest rate that you will be getting. Right now, the prime rate is 7%. So if a bank can offer you a home loan, which is prime, or even better, prime less, say 0.5 or 0 prime minus 1, then that's even better. If you look at the current rate of 7%, if you get prime minus 2, then that's you only pay 5% on your home loan, which is I would say is a very good deal. But if the bank can offer you anything less than prime, that'll be excellent. Typically, the interest rate that the bank is willing to offer you also is based on your financial standing and your credit score and your credit worthiness. So typically, the better you are in terms of credit score and your income, then that you probably will be able to secure a more favorable interest rate compared to someone who's got problem with the credit, and they've been battling to pay monthly installment the last 12 to 24 months. They will probably not have such great credit score. So in that case, the bank will probably offer that person a higher interest rate in order to compensate for the higher risk of default in the future. So that's important. So you do want to compare the interest rate that you get from the various banks, and obviously you should want to go with the bank that give you the lowest interest rate possible. And then the third is the term. The third is the term of the home loan or mortgage bond. So typically in the past, the term is 20 years, which is 240 months. So 20 times 12 is 240 months of repayment period, so that the bank will give you a 20-year home loan, and that over 20 years you pay a monthly installment, and then you pay off the home loan. But because of the financial obligations, especially to the younger generation, I think that some banks, they start to offer longer term, the 30 years. So again, you do want to understand when the bank offers you the home loan, what's the term of repayment? Is it 20 years or 30 years? Because if you compare a bank which give you a 20-year home loan to another bank which give you a 30-year home loan, on paper, the bank that offers you a 30-year home loan could show you a lower monthly repayment amount. But the fact is that because they extended the repayment over a longer period of time, and that's why it looks to be a lower, but over a 30 year that you potentially you will be paying a total repayment which is higher than a home loan which is over a 20-year period. So understanding over which period you are going to repay the bank is important. Is it 240 months, is it 20 years, is it 25 years, 30 years? And so don't be fooled just by looking at the repayment amount. Okay, so that's important to pay attention to in terms of the term of the home loan. Is it 20 years, 25 or 30 years? Next is the repayment amount. Yes, so most people, for people who are not so financially aware or literate, and then people who generally struggle with the numbers, they just pay attention to this, which is called the repayment amount, which you pay on a monthly basis, and they just say, okay, I can afford it, let me go for it. But please, you must be very careful. Don't just look at the repayment amount and then make your decision. All right, take the other factors I told you and ask this question. Look for this kind of information before you make the decision. The repayment amount tells you on a monthly basis how much you need to pay. All right, so that would include a portion which is a capital repayment, the amount you pay the bank, as well as interest. So in financial calculations, we talk about mortgage, we talk about amortization, and then we talk about every repayment amount. There's a portion that's used to pay the capital, and there's a portion that's used to pay the interest because you owe the bank, they say this 2.5 million or 3 million rand, and there's a monthly interest that you pay on that kind of a capital amount. So that will be part of the repayment you pay every month. So that's important to understand. Right, and also that you need to assess your affordability. So typically the bank will look at how much would you be paying on a monthly basis in terms of this repayment amount and as a ratio to your income. And then let's say, for example, a monthly repayment on this 3 million home loan is going to be, for argument's sake, let's just make it simple, it's going to be 30,000, right? 30,000 rand. The bank will want to know, would you have the financial resources to repay that on a monthly basis, and do you actually have a buffer? So typically they will say the ratio is about 30%. That means that you should not, the repayment should not be more than 30% of your monthly income after tax or your take-home pay. So they say, for example, your take-home pay is 100,000 rand, and the bank grants you this home loan of 3 million rand. And your monthly repayment is 30,000 rand. And 30,000 rand over 100,000 rand take-home pay, the ratio is 30%. The bank feels that they're comfortable. Obviously, they look at other things as well and your monthly budget. But generally, the bank will feel comfortable that you do have a sufficient kind of a coverage to pay this repayment amount. And so they will be comfortable in lending the money to you. However, if your ratio start to get to 40%, 50%, that start to be the upper limit of where the bank considers safe to lend you the money. If the ratio is more than 40% or 50%, I think even for you as a person, you will need to think very hard about, do you actually want to get the home loan? Because even if a bank can get a bit reckless and give you the loan, but then the problem is affordability. Would you be able to afford it? All right? Because that if you can afford it now, if you can even just scrape through and say you can stick it out and you can pay for the next few months or next year, the problem is something can happen in the current economy with the COVID and with the recession that's taking place, even though the economy is going to recover this year, but there's still a lot of uncertainties. Maybe something will happen in your line of work, maybe something will happen in your business. You may not get the same amount of income as you were hoping on for your home loan. Then you're going to struggle, and you don't want to have in a situation where a few months down the line, a year or two down the line, that where you're not going to make good the payment, then the bank is going to knock on your door, and then maybe even to take your property away. You don't want to have that situation. You want to plan, and you want to make sure that you have the resources that you're going to be comfortable in repaying that in the future, in 2 years, 3 years, even if there's something going wrong with your business or your job, and you're still able to afford it. And that's important consideration. So when you look at repayment, don't just look at that number, that absolute number, but you need to think about how is that related to your monthly income, monthly take-home pay after tax, all right? And if the repayment amount constitutes less than 30% of your monthly take-home pay or your monthly income after tax, then yeah, I think that you're in a comfortable range. Then that shouldn't be a problem for you to continue to have that discipline to pay that amount on a monthly basis. Next is about, is it variable interest or is it a fixed interest rate? And that's also important consideration. Should it be variable interest rate or should it be fixed interest rate? And here is the trick, is that you need to ask the bank, if I have this variable interest rate, what's the interest rate I'm going to pay? And if it's fixed interest rate, and what's going to be the fixed interest rate I'm going to pay, and for how long? All right. So if it's variable interest rate, that means that the interest rate you pay is related to the prime rate. So should the prime rate go down, then the interest rate you pay is also going to go down. Should the prime rate go up, then your interest rate you pay is also going to go up. All right. So then you do need to understand what's going to happen. You need to have a bit of understanding of the economy. Maybe you can ask the banker, but you do need to understand what's the kind of a trend with the interest rate. All right. If you do expect the interest rate to go down, then it's rather better to take variable interest rate, because you know that should the interest rate go down, then that is going to work in your favor. Then your monthly repayment is going to reduce, because the lower the interest rate, the lower the monthly repayment, because every month the interest portion of the repayment is going to reduce. So that will be working in your favor. So in an environment where the interest rate is likely to go down and go down even more, then you will want to take the variable interest rate option instead of fixed interest rate. Because that when you go with a fixed interest rate, typically the bank will give you an interest rate that's higher than your variable interest rate. So Yan said to me that the bank will give him, if it's variable interest rate, currently it will be 6.5%, which is prime minus 0.5%, which is, I think, is a good deal. Maybe if he can negotiate even better and get a prime minus 1, that will be 6%. But then the bank, if it's a fixed interest rate, the bank is willing to give him 9%. All right, 9% on paper, it's a lot higher than that 6.5%. Then the question is that, do you want to take the fixed interest rate? Then the question you need to ask the bank is that, for how long is it going to be fixed for? All right, is it going to be for 2 years, 3 years, or 5 years? And then it's about the outlook for the future. And in the kind of a bet, what's going to be the inflation and what kind of action that the Reserve Bank is likely to take, when is their interest going to go up. So they're going to hedge their bets, so to speak. So if it's fixed interest rate, they're going to take that risk if the interest rate goes up. And that's why the fixed interest rate generally will be higher than the variable interest rate, because they're taking that risk and they're taking it onto their balance sheet, and they're offering you this fixed interest rate and take that variability or the uncertainty out of your hand and onto the bank. So that's why they will want to charge a higher interest rate for a fixed interest rate arrangement. And that's why you need to understand these dynamics. But if the fixed interest rate option the bank gives you is much higher than the variable interest rate option the bank gives you, let's say the difference is 2.5%. Take 2%, 2.5%. I think in most circumstances, I would say no to that fixed interest rate option. I think that's just cost too much. I'd rather save money with a variable interest rate. Maybe at some point in time, the bank is actually going to hike the rate, and in some point in time, it's going to be 2%, 3% interest rate hike. Then maybe we'll get to that kind of a fixed interest rate that was starting to look attractive. But if it's the differential in the interest rate between the variable interest rate and the fixed interest rate is as huge as 2.5% or 3%, I would suggest that it's rather better to take the variable interest rate, save the interest cost, and then rather don't go with a fixed interest rate option. If the fixed interest rate option is not much higher, is only 1% higher, and if it's locked for 5 years, I would say it's a good deal, because I think that right now the inflation is picking up, and I can see the commodity prices are going up, oil prices going up. And I think that what I heard from the economists and also from the fund managers, I think there's a good chance that the Reserve Bank is starting to hike interest rate maybe in the second half of this year or early next year. And so from this point on, I think that the chances are that interest rate is going to go up. I don't think it's going to go up too fast, because that the Reserve Bank is still very cognizant of the weak economy. It didn't want to hike up the interest rate too much, too fast, to kill the economy or kill the recovery of the economy. And so that's what's going to happen. So I think it's, if you're looking at the argument for variable interest rate or fixed interest rate, I think that based on my experience, I typically find that it's still better to go with a variable interest rate, even though you don't have that fixed. But I think generally my experience shows that it works for me. That's the other thing that's very important to think about in terms of whether it's go variable or fixed. And that's going back to our previous point about repayment amount. Okay. Right now we're in a low interest rate environment in South Africa. I think some analysis show that we are in the lowest interest rate over the last 30 years. So we have never seen this kind of a low interest rate in South Africa in the last 30 years. So we're in a low interest rate environment. So you need to be cognizant, all right? In the future, the Reserve Bank, in order to combat inflation and to bring inflation in control, you will start to hike interest rates. If the interest rate starts to go up, that means your monthly repayment is going to go up, because that the interest goes up and the interest portion of your monthly repayment is also going to increase. So then the question is that, would you be able to afford when the interest rate goes up and your monthly repayment goes up as well? All right, and you need to think about it and budget for it. If you don't know how to work it out, you can ask your banker to give you an illustration. If the interest rate goes up by 3%, what's going to be the repayment? If you don't get that from your bank, speak to a financial advisor or your financial advisor and say, if this is my repayment on a monthly basis, can you just help me to work out if the interest rate goes up by 3%, what's my repayment going to be? And then you need to sit down and say, if that's a repayment, if the interest rate goes up by 3%, can I afford it? And you need to be realistic about it, because you don't want to have the situation where you max out. You buy the biggest house you can get because you can afford it. The bank tells you that they can give you this loan, and you now go and just buy it. And then 2 years down the line, you find that the Reserve Bank actually hikes the interest rate by 3 percentage points. And then you find that you're in a state of trouble, because that you suddenly find that the monthly repayment is more than you can afford. Then you don't know what to do, or you're short and you might be forced to sell. And then that is always not a good idea. So always just check on that. Allow for that buffer, all right? Think about it. into the future. In 3 years' time, 5 years' time, should the interest rate revert to normal or even go up by 3% or even 5%? Would you still be in a position to afford the repayment? Okay, that's very important because I've seen clients where they couldn't afford the repayment and they had to downsize. They had to sell, and then when you sell the property, you incur costs, and when you buy property, you incur another set of costs. Actually could set you back financially. All right, so that's very important consideration. Next, and then something that Ian said to me he really appreciates a lot is the concept of an access bond. So all the banks, and they should offer you this facility, and if they don't tell you about it, you ask it, all right? And you make sure that your bond has this access bond facility. And access bond is a term that's coined by Standard Bank, and I must give credit to Standard Bank. They have done this marketing so well over the years. All I remember is this access bond, all right? So essentially, access bond, what it is that it gives you the ability to take money out of your home loan should you have made excess payment into your home loan. So essentially what it means is that you want to make sure that your bank allows it, and generally the bank will welcome it, which it is that when you have money, maybe you get a bonus, or maybe your business is doing well and you want to channel more money back into your home loan. You want to pay off your home loan sooner than the monthly repayments. Generally, the bank will allow you, but just ask and then just check that is okay. Will they allow you to pay more into your home loan when you have the money? And when you pay the money more money into the home loan, all right? And that's actually you pay that sooner, and then that you're reducing the outstanding capital amount. And if you have that excess bond facility, and different banks, they might call it in different name, but essentially it just means that if you have paid excess amount into your home loan, maybe over the last 2 years or 3 years, you have paid, say, another 50,000 rand into the home loan, 100,000 rand into the home loan. And then at some point in time, you don't need the money. You can take the money out of the home loan instead of applying for another loan or get a personal loan, or maybe load it onto your credit card and pay a higher interest rate. But then you can just access that amount in your home loan, all right? Then that's beautiful. So I've been using that over the years, and that I think is a great financial planning, personal finance tool. So make sure when you speak to your bank about a home loan, and just ask them, on this home loan, do I have the access bond facility where I paying extra money and later on I can access the extra money I paid into the home loan? So maybe they say, for example, you paid 200,000 rand into the home loan and then more into the home loan, and then later on you want to buy a car. You probably can access that money and then to fund for your new car. And then essentially you get your car finance, but at a much lower interest rate, because typically when you have a home loan, you might negotiate with the bank to get a prime minus one prime interest rate, which is right now 7%. But whereas when you buy a car and you apply for a vehicle finance through West Bank or another financial institution, typically you'll get prime plus one, prime plus two. I've seen clients even paying prime plus three. So if you're buying the car using the money from the home loan through the access bond facility, you're just paying that vehicle finance at prime minus one. Wow, that's from the financial planning point of view, that's beautiful. All right, so you want to make sure, because that gives you flexibility, that gives you in the future, should you need money, maybe for paying off maybe for your education, or maybe say, for example, you want to pay for your car, or maybe say you want to go on overseas holiday, that gives you a much better interest rate compared to getting a personal loan or credit on your credit card. So that's a very smart option. That's something that you certainly want to avail yourself of with a bank. Lastly, you want to pay attention to the additional costs. So when you apply for a home loan, the bank will give you the offer, they will give you the quotation, they will list all the charges. You need to understand what's the admin charge, what's the additional charge, is there an insurance cost. The bank invariably they want to force down your throat, sorry, the banks out there, but they will want you to take the insurance. Okay, they want you to go with a financial advisor to take this life cover. All right, but just pay attention to this. The bank cannot force you to go with the insurance, cannot force you to take up their life cover. All right, you have the options. Yes, the bank can say as a condition of the home loan, you need to cover your house. As a condition of home loan, you need to have life cover because you want to make sure should something happen to you, then the loan is covered or paid for by the insurance company. But the bank, they cannot have this anti-competitive behavior to say that, to force you to say you definitely need to take their homeowner's insurance, their building insurance, or take the life cover through their financial advisor. I think that they will have problem with the competition commission should they have this kind of behavior. But then they say it's a condition, but then you should be free to approach the market. You can go to the insurance companies out there, maybe Santam, Assurance, My Way, etc., or go with your insurance broker, get quotes from your insurance broker or financial advisor that you work with, and get quotes. All right, and then you can sit down, and then typically your insurance broker or financial advisor will explain to you the advantages and the disadvantages, what are the features of this policy, or that what are the costs, what are the exclusions, etc. So to make sure you get the best deal. All right, so important when you get the quotation from your bank in terms of looking at the costs of this home loan, these are the additional costs. Pay attention to those additional costs, admin costs, insurance costs, whatever they add to that. Just check and ask the question. All right, and they say, what's this, or is it necessary? Typically, that the bankers and the lawyers, they will just tell you sign. All right, but don't sign your life away. All right, understand exactly what you're signing for, what costs are you paying, and is it compulsory or not. And don't be fooled by the lawyer or the bank that in order to just want to ask you to do everything, sign everything, and don't want you to ask questions. That's not right. Okay, I've done 4 or 5 home loans in the past, and it's your right as a consumer to ask questions. And it's your right to say, no, I don't want to take this. I don't want to take this insurance. I don't want to take this life cover. I've already got life cover. I already got like group life cover with my employer. I can cede that life cover to cover this. I don't need to take additional life cover. All right? So that's very important. Don't spend additional unnecessary money on these, because the bank, obviously they're there to make money. They want you to do additional your house insurance, your property insurance. They want you to do the life cover, everything, and load up all the costs because that's good for their profits. All right, but then you as a consumer, you need to ask the question, is it really in my interest to do that? Speak to your financial advisor, speak to an insurance broker, and make sure you have your rights. All right, and you are getting the best deal, and don't spend on the extra or double the costs. Okay, because if you can save a few $100 here and another few $100 there, then you save $1,000 every month, and that you can use better for investment. All right, and or saving and things like that, instead of just double your costs everywhere. So that's something I certainly would recommend you just look like the fine print, look at the costs, and ask the questions. If you're not sure, work with a financial advisor and make sure you don't pay more than what you need to. All right, so I hope you like what I have to share. And if you like this program, please click on the like, subscribe, and share. And we really thank you for you watching this video and your support. Goodbye.